Joining me today, CFP Chad Burton, to talk retirement issues. In particular, in the world of incredibly low interest rates, in a world where the stock market hit record highs again, how are you telling your clients to allocate their portfolios when they're heading into retirement?
Yeah, I mean, you really have to start that transition about 10 years from retirement. You've got to go from the wealth accumulation to setting up your portfolio for the wealth distribution age. And really, you get main components. You have a certain amount of cash, you have a certain amount of stocks or equities, and you have a certain amount of bonds. Now, the cash formula never changes in retirement in terms of what the minimum is. Stocks and equities, the core of that also doesn't change in terms of the dividend type paying stocks that you're going to want in a portfolio. And probably the bonds, Rob, are the most challenging part in this economic environment where we have central banks around the world purchasing their own sovereign debt.
So if cash doesn't change, what levels should we keep cash at, roughly, generically speaking?
Yeah, well, I got into the business, 20 years ago, and before I got in, I was majoring in engineering and math. I love spreadsheets, love looking at historical returns, and realized that the market had corrected 3 years in a row. And then shortly after I got into the business, it corrected in 3 years in a row again, 2000, 2001, and 2002. So you want to set up a portfolio in retirement so that you can get through the bad times. 7 out of 10 years are positive, 3 out of 10 years are negative. And only twice in the last 100+ years has the market been negative more than 2 years in a row. But it could happen again. You're retired at 65, you could live till past 100. So you have to realize that that's probably going to happen again in that 35+ year period. So cash is king during downturns. Your portfolio can recover. Let 1999, let 2007, people should realize portfolios do recover, but you've got to have cash and dividends to get through that bad time. So you need 3 years worth of expenses in cash, and that's really portfolio draws. So in terms of the formula on how much cash a person needs, you need to know what your gross expenses are. That's what you're going to spend, what you're going to pay Uncle Sam, your insurance costs, your healthcare costs. You can subtract out from that your Social Security, your really dependable income like rental income or pension income. And that formula, that resulting number, you need 3 years worth of that in safe money.
You mentioned that bonds are the trickiest part in retirement. What alternatives would you suggest?
Well, you do have to look at some bond alternatives. First of all, you really have to look at your portfolio, make sure you're shortening up your duration. So I still find people that come in and they have long-term government bonds or funds with a duration of over 6. Duration is really it's kind of a long topic, but it's the sensitivity of interest rates. How much money will that bond fund tend to lose if interest rates rise by about 1% or so. So you have to shorten up the duration. Retirees that are older, they can look at also, there's some new no-load variable annuities that have popped up that allow you to have a balanced portfolio, but the insurance company says that no matter what the market does, they'll pay you 4 to 6%, depending on your age, of that amount for the rest of your life. And until the 10-year Treasury is over 4% again, Rob, those are pretty decent bond alternatives for about maybe 20% of a portfolio.
So how much does a retiree need in stocks? And you mentioned something, core equity. What is core equity and why do I care?
Well, core equity, especially as you go into retirement, and I'm a big believer in dividend achiever stocks. And these are stocks that I still like to find growth companies, but they have to pay a dividend and they have to have a record of consistently raising their dividends. So most of the stocks that I own have consistently raised their dividend on average 10% a year over the last 5 and 10 year periods. So what that allows an investor to do is, if these types of companies they're still growing, but they pay their investors either on a quarterly or biannual or annual basis. So if the market's going down, they still have a history of increasing their dividends. And so you get paid to wait. The 3 out of 10 years that are negative, you know that 7 out of 10 years are positive. Eventually the chart's going to be higher, and those types of stocks pay you to wait and often increase your income even during a down market. That's a very important core piece of a retired person's portfolio.
Any last things you want to mention in this segment about what we're talking?
Well, yeah, you have to have a plan to rebalance your portfolio. So you've got your 3 years worth of expenses in cash, and then you have to have a portfolio that has a certain amount in large cap, small cap, mid cap, international, and bonds, and then rebalance your portfolio. Constantly peel off growth to replenish your cash, that 3-year goal that you have.
Let's pull up his contact information. CFP Chad Burton. He is an expert. He's a bigger financial nerd than myself, according to him. He reads financial charts. You can find him at newfocusfinancial.com. That's newfocusfinancial.com. Phone number 888-762-2423. That's 888-762-2423. Drop me an email, rob@robblack.com, or call in 415-561-8753. That's 415-561-8753. We'll take a break here. We'll be right back on Rob Black and Your Money. Again, this is a show dedicated to getting you to retirement. We talk a lot about that on the show, so you can call the show with your questions. 415-561-8753. That's 415-561-8753. Or drop me an email, rob@robblack.com. But once again, let's welcome back in CFP Chad Burton. Chad Burton, let's talk asset allocation. What is it, and what should a retiree's asset allocation look like?
Well, I kind of separate the asset allocation and retirement because, like I said, you need to have 3 years worth of your portfolio draws in safe money. And when I mean safe money, it's things like I-bonds, short-term treasuries, CDs. And it's a little bit painful right now with low interest rates to have that much safe money because there's not a lot of places you can go. You can shop, for high-yielding FDIC insurance products like bank accounts on bankrate.com where you might be able to get 0.8 or 1% a year. But that's to get you through the tough times in the market. So I have my cash set aside, and then I have the portfolio. And in the portfolio, you still need 30-40% in fixed income. Some of that's going to be in some fixed income alternatives like we talked about, like no-load variable annuities that offer lifetime income guarantees. Not loaded products. Don't go to a bank or an insurance person to get these things because you can get no-load versions. You want to be able to come and go as you please, and you don't want your financial advice from somebody that's earning a commission. So keep that in mind.
You never want to sell low, but there's good stock markets, there's bad stock markets. When do you rebalance your portfolio in those two scenarios?
You constantly rebalance your portfolio, at least twice a year in retirement, if not 4 times a year. But the way that you do it is when the market is up, you look at your portfolio and you have to have a written investment policy that says how much do I have in large cap, how much do I have in small cap, mid cap, international, emerging markets, commodities, real estate, other alternative investment asset classes like master limited partnerships, things like that. But the key is when the market's up, the first thing you do, you look to the areas that have done well, and you peel off enough growth from those areas to replenish your 3 years worth of safe money. And then after that, once you've replenished the safe money, then you rebalance in the portfolio. You're always peeling off the house money on the good years and putting it back into the places that haven't done as well. Because as soon as everybody's running away from an asset class, whether it's emerging markets, small cap, whatever it may be, that's usually the best buying opportunity. So don't invest based on what your gut's telling you. Invest based on what has worked well over the last 20, 30, and really 100 years.
For retirees, there's a teeter-totter between spending down your assets versus saving your assets. You don't want to start spending too early. When does the retiree know it's time to spend a little bit more? When does the retiree know I better underperform my budget because I don't want everything going out the door?
Yeah, that's a great question because a lot of people just go into retirement and they reverse dollar cost average out of their portfolio, which is too dependent on market timing and whether or not the good years come first or later. What you really have to do is always track your expenses at least annually. And expenses mean everything from what you're spending in your household to taxes to all the insurance. And you're always tracking that number versus your early projections and your retirement planning. Because Social Security goes up a little bit, but Medicare Part B goes up even more typically. So what you have to do is say, how is my portfolio done versus what I projected, and how have my expenses done versus what I've projected? If your expenses are on track and your portfolio is done as well or better than projected, that's when you can bump up that income to keep up with inflation. But if something's behind, either you've spent more than you thought or your portfolio hasn't done as well as you thought because of low interest rates or central bank easing, subduing growth around the world, then you might need to keep a flatline expenses for 2 to 3 years before you boost up that income and put yourself in a risky area.
It's a strange teeter-totter. It's a lot of work. You spend your whole life accumulating wealth, and you have to manage it. And manage it means watching the spending, watching the saving, make sure you don't run out of your equity before it's time to kick the bucket, so to speak.
Right.
But like you always say, try to bounce that check to the corner because he's not going to come after you at that point in time.
Right.
Let's pull up CFP Chad Burton's contact information, New Focus Financial, newfocusfinancial.com. 888-762-2423. That's 888-762-2423. And you'll see more of them in the future, I'm sure, but you can find them today at newfocusfinancial.com. You can call today's show, 415-561-8753, or drop me an email, rob@robblack.com.
The news and views expressed on this program are not necessarily those of Cron TV, its management, or advertisers. Consult a broker or advisor before taking any action on the stocks mentioned on this program.